Okay. Good evening, guys. My name is James from Varsity Unlimited Tutors. We're an organization that specifically helps students with assignments, lessons, and research, where we just try to go through the different coursework and homeworks and research that you need to do as students and just try to help you so that at the end of the day, you secure your education and you pass your degree. Right. So my name is James. I'm the CEO at the organization. And I just wanted today for us to just go through a couple of things for this semester. So last semester, we worked together. I believe we did managerial economics, we did operations, we did strategic marketing, and information knowledge management. So this semester, we have got some modules that we also are going to be assisting with if you need some assistance, right? So as usual, in each semester, you are going to have 4 modules. So you're going to have 4 modules this semester. You have financial management, you've got HRD, you've got research and quantitative methods, and you've got corporate strategy, right? So these 4 modules, in each module, you are going to have 2 assignments and an exam. So where we usually come in is on the assignments part to just help you with the burden of writing the assignments, where we give you the guidelines of how to do the assignments, right? So there will be 2 packages. Package number 1 will be the one where we assist you in a group setup, just like we've come through today. So we are going to meet together and we're going to go through the HRD assignment. Going to go through the case study and the project together, go through the questions, highlight the different areas within the assignment that you need to take account of. Then we are also going to meet to do the financial management assignment together, right? And then we are going to do research and quantitative methods, which is a bit of, there's some quantitative parts in there that are a little bit difficult, but usually it's a straightforward module. And then finally, corporate strategy. Right. So if you do not want this type of assistance where we get into the classes and you want a more one-on-one approach, you can give me a call. We can discuss how to structure it and how to help you on a one-on-one basis. But usually we do the group classes. But there is also one-on-one assistance if you need it. You just have to give me a call and then we can discuss further. Right. Then when are we going to meet? Right. Or before we go to when are we going to meet, maybe let's discuss the prices, right, of what are you paying for and what are you getting, right? So it's the same as last semester. It's 700 for each module or 350 Rand for each assignment. You are going to get the assignment classes, right, for the case study and also for the project. Then in addition to that, I will also send specifically looking at financial management and also for research and quantitative methods. I'm going to send you videos from previous semesters. So like, for example, the assignment that I did in 2024, we did about 4 different assignments. I'm going to send you videos for those. The assignments that we did in 2022, the assignments that we did in 2021, I'm going to send you videos and answers for those ones so that you can use them in your revision. Because what I've noticed about your lecturer, especially for financial management, the same questions that are in the assignment are basically the same questions that are in the exam. The only difference is going to change the numbers, it's just going to change a little bit of the things, but the structure of the questions is usually the same. So you can actually revise for your exam using previous assignments. Right, that's actually a technique that we usually use. So we can also make those available to you at the same price of 750 for the entire module. That is for the assignment, plus those videos that can help you to prepare for the exam. Then lastly, in addition to that, remember, after each video that we send you, we also send you a sample of the assignment answer, which you can use as a template in terms of preparing your final answer at the end of the day. I would emphasize, do not submit our samples that we give to you. Just use them as a general template that you can use for your own answer at the end of the day. Right. So that's in terms of the prices. Right. Then in terms of when we are going to meet. Right. So the first assignment class is going to be for financial management. It's going to be this Saturday at 5 o'clock. So financial management this Saturday at 5 o'clock, we are going to go through the case study assignment. We're going to go through the case study assignment for financial management. So here I've given you for case studies, but for projects, we're going to give you the dates at a later stage once the case studies are done. But the 700 Rand includes both the case study and the project. If you want to manage your finances, maybe you can pay 350 and we do the case study. And then when we do the project, you pay another 350. Right. So this Saturday, 20 January, we are going to do the case study. The next Tuesday and Thursday, that is 23 and 25, we're going to do HR development, human resource development. Then the Saturday afterwards, we do corporate strategy. And then the Sunday, we do research and quantitative methods. This way, by the time we reach 1 February, we are done in terms of giving you the material for the assignments. It's now up to you as the student from 1 February up until 20 February, when the first assignment is due, to actually find the time to actually do the assignments at your own pace. And then somewhere around 20 February, then we start doing the projects together, right? So for the case studies, we want to be done by 1 February. We want to make sure that all of them are done so that you can have time to do them by yourselves and find time to paraphrase, to research, to add more materials, and etc. the whole of February, whilst we are also preparing to do the case studies for you. Right? So that's in terms of the timetable. Right? So for the rest of this class, I'm going to talk a little bit about financial management. And also, we are going to maybe do one of the questions. We're just going to do a portion of the question just to show you, in case maybe you did not attend the lessons last semester, just to show you how we work together as a team, right? But before I do that, are there any questions that any of you might have for me? Are there any questions for me? No questions. That's good. All right. So let's proceed. Right. So financial management. So what does? Okay. Hello.
Yeah, I just want to ask if you are going to send us the timetable.
Yes, I'll send it through.
For the classes, for the sessions.
Yes, I'll send it through.
After this.
Yes. Yes.
Okay, thank you.
Right. So for financial management, what is financial management? What does it cover? Right. So in an organization, we have accountants and then we have finance managers. An accountant is someone who is focused on the bookkeeping part of an organization, i.e., they try to record, measure, and report the financial standing of an organization, whether the organization has made a profit or whether the organization has made a loss, and what is the value of the organization as a whole. That's the job of a bookkeeper or the job of the accountant. But when someone is given the role of a financial manager or any other general manager, when they are looking at the function of financial management, you are looking at how the decisions that you make as an organization can benefit the organization. So, for example, right, as a business, you might have a decision. Let's say that you are in the business of manufacturing motor vehicles, like a Toyota, right? You're in the business of manufacturing motor vehicles. And you notice that in South Africa, there is increasing demand for the Toyota brand in South Africa. So you might say, look, if we continue manufacturing Toyota in Japan and moving it to South Africa by sea freight, it might be too expensive for you to do that as an organization. So you might decide and say, look, why don't we move closer? Right? So you might have an option, for example, and say, we can locate our plant in South Africa because that is our biggest market. But you might also think, look, we also have people in Botswana, people in Mozambique, in Namibia, in Zimbabwe, in Zambia that are also buying the Toyota brand. So if we locate our plant in South Africa, we can also service those particular markets. What if we locate our plant somewhere where it is cheaper, whether it is in Zimbabwe, whether it is in Namibia, or in Tanzania, somewhere close to South Africa where it is cheaper. So you have different options. The plant can be located in South Africa. The plant can be located in Mozambique, right? So how do you make that decision? That's now a finance decision because it's a decision related to the revenues and the costs that are allocated to the specific cost center, i.e. Mozambique or South Africa. So you're going to take all of the inflows and outflows related to each particular country, and then you're going to make a decision using the net present value method to say that I am going to allocate my factory in Tanzania because it is the cheapest area where I get the most value as an organization. And then I'm going to send the vehicles to South Africa, to Namibia, and etc. From what? From Tanzania, right? So the making of that decision is what financial management is all about. So that's one example. Another example could be maybe you want to, let's say that you have decided that you want to locate the plant in South Africa, right? And then you say, how do I finance the plant? Should I, number one, use the cash that I already have in the bank account? Or number two, should I take out a bank loan to finance this specific endeavor? Or number three, maybe I should issue new shares, right? Go to the shareholders and ask for money from the shareholders to finance this particular plant, right? So now you're doing a capital structure, right? You know, you have to calculate what is the required rate of return if I am to use a bond, what is the required rate of return if I'm to use shares and etc. So that you can compare and use the one that is the cheapest for your what? For your organization, right? Or alternatively, maybe you've decided, look, I do not want to locate the plant in South Africa. I don't have the resources to do that. But then you think, look, there is a company, maybe it's VW, that already has a plant in South Africa. Why don't we go and acquire VW? Why don't we go and buy VW? Then we ask now the plant that of VW that's in South Africa to also do Toyota cars. So they will do VW and they also do Toyota. But for you to make the decision, how much money should we spend in buying the VW company? That's now what? That's now mergers and acquisitions. So you can see all of these things. It's one decision that you're making, the decision of manufacturing for your organization. But you are involving issues of where to locate, how to finance, how to make the decision. All of these things are under the financial management perspective. So you will notice that there are a lot of different areas that you as a manager in business are going to make decisions for that you did not know before, but you could increase the productivity or the value of your decisions or the accuracy of your decisions by applying financial management concepts. So that's what financial management is all about at the end of the day, right? So let's look at an example of it. So this is actually from your question paper. This is from your question paper, the assignment, the case study assignment. If you go to question number 3, it's worth 0.5 marks. It has got a company, Liverpool, that needs to make a decision. So it says here, Liverpool needs to upgrade its utility capacity, right? They require a new generator costing 1.2 million, and the generator can be leased, and the terms are as follows. So the company needs to upgrade its utility capacity, right? Maybe Liverpool here, maybe it's the one that plays soccer, right? So maybe they need to upgrade their stadium, right? So maybe because of power issues, their stadium needs a bigger generator so that it can supply more lights and then they can increase the size of the stadium. I don't know the reason, but they need a generator, right? So for them to make the decision of how do we buy the generator? Do we use cash to buy the generator? Do we go and get a lease to buy the generator? Do we get a loan to buy the generator? That's the decision that they need to make here, right? So you are given 2 options by the lecturer. Option number 1 is called a lease. Option number 2, they're using their own cash. So the option of using their own cash is you're just taking cash in the bank account and you're paying and then getting the generator, right? But the option of leasing, a lease is like a loan where you go to a company, they give you the generator, and then you pay them some monthly installments. at the end of the day. So you as a company, you don't just say, we have money in the account, we run and give them. No, no, no. You check which option is cheaper for you as an organization. And how do you do this? You do this by applying the net present value of money concept, or the discounted value of the time value of money concept. We're saying that money is valuable today than tomorrow. So you apply that particular concept. So let's go through the question together. Okay, just in a second. Just give me a second. All right, it's fine. Okay, sure. But I'm gonna remove my video. I hope you can all see. If you cannot see, please highlight. I hope you can all see here. Right. So what we're going to do, we're not going to do the whole question. We're just going to do a portion of the question. Right. So says here, cost of leasing. So we want to evaluate what is the cost of having a lease for this specific organization. Right. So when we're evaluating the cost of leasing, we're going to create a table. Right. So my table here, the first thing that I need to know is how long is the lease going to be? It says here, the lease is going to be terminated in 4 years. So I need 4 years, right? So my table here, I'm going to create 4 columns and many rows. 5 columns, sorry, and many rows, right? It's fine. So I'm going to have year number 1. I'm going to have year number 2. I'm going to have year number 3. And I'm going to have year number 4. And then I'm going to have narration. So what I'm going to do is I'm going to assess all of the inflows, all of the money that is coming into the organization, and all of the money that is going outside of the organization. And once I have done that, I'm going to get what we call a total cash flow. Right? I'm going to get a total cash flow. Once I have a total cash flow, then I'm going to get a discount factor, which is the time value of money concept. And then I'm now going to get the present value of my cash flows. And then once I get the present value of my cash flows, I get the net present value, or what we call the cost, which is what we are talking. That is the cost of leasing, right? The net present value will become our cost of leasing. So now let's go through the cash flows. So the first cash flow, the lease would require annual end of year payments for 4 years. So it means that each and every year, I'm going to pay some lease payments. So year number 1, I'm going to pay 320,200. Right? This is negative. All right, let me put negative instead of brackets. But usually we prefer to write brackets. In fact, let's do the correct thing. Let's use brackets, right? Brackets means it's negative. Bracket means negative, right? So year number 1, I'm going to pay that much. Year number 2, same amount. Year number 3, same amount. Year number 4, same amount. So that's a lease payment that I am going to pay each and every year, right? Now, whenever I pay lease, I'm sure most of you guys, you're in managerial positions. You might have heard about what they call tax write-offs or tax advantages, right? So a lease, for example, is a tax write-off or a tax advantage. It means that you pay your lease before you pay your taxes. So let's say that your company had made a profit of 320,000 Rand, which means that after you made your profit, you pay your lease, and then you don't have to pay any taxes because you have paid for your lease, right? So that's what a tax advantage is, right? So essentially what it means is we go and take the tax rate and apply the tax rate to the what? To the lease amount. When we apply the tax rate to the lease amount, we get what we call the tax advantage, or what is called the tax shield in accounting. So what we want to calculate is what we call the lease tax shield, or in layman terms, the lease tax advantage. That's what we want to calculate here. So this is going to be equals to the lease payment multiplied by the tax rate, right? So which means that our lease payment is 320, 200 multiplied by our tax rate of 0.28. And that gives us 89,656. All right. So that's our tax advantage. Remember, this is the tax advantage. It's like money returned back to you by SARS, by the tax authority. Right. So that's why it's positive instead of negative. Right. So lease payment is negative, but the tax shield is going to be positive. Right. So that's the first payment. Second payment, service and insurance costs of 78,500 per annum will be borne by the lessor. Will be borne by the lessor. So you now need to understand terminology. What is a lessor and what is a lessee? A lessor is the owner of the machinery, the person who is giving you the loan. A lessee is you, the company. So they are telling you that the service fees and the insurance for that machinery, you are not going to pay it. It is going to be paid by the owner of that part of that machinery. So this expense does not affect you as an organization. If the lecturer had said it's going to be borne by the lessee, then it would have affected you. So you ignore this expense. We'll go to the next one. The lessee will exercise the option to purchase the asset for 80,000 Rand at the termination of the lease in 4 years. So the lessee, which is you, will buy the asset for 80,000 Rand at year number 4. So we're going to say here, purchase of asset. And we're going to go to year number 4 and say we're going to spend 80,000. You remember, we are spending 80,000. That's why it's negative. Right. So those are our what? Those are our inflows and outflows. So now we calculate the total cash flow. Okay. For year number 1, it's going to be 320, 200 plus 89,656. And that gives us here negative 230,544. So that's the same amount for year 2. That's the same amount for year 3. But in year number 4, there's an extra 80,000 there, which is going to make it 310,544. Right. So that's our what? Our total cash flow for year 4. Right. So now that we have got the total cash flows, so this is the money that we are going to spend for us to buy this machine. But remember, we are financial managers. We don't take money as it is. We know of the time value of money concept. The time value of money concept simply states that if I tell you right now, I can give you 100,000 Rand today, or I can give you 100,000 in 10 years. You will always say, give it to me today. Why? Because the 100,000 today is worth more than the 100,000 in 10 years' time. Again, think of bread. The price of bread in 2010 was probably about 10 Rand. But the price of bread today is 22 Rand. So the value of 10 Rand in 2010 was worth more than the 10 Rand we are using today. So because of that, whenever you are making these decisions as a finance manager, you want to calculate what is called the present value of money, or the value of money today. That's what you want to calculate for you to know the true profit that you are gaining from a transaction. So for you to be able to do that, you need what are called present value tables. So these are in your study guide. At the end of your study guide, under the appendices section, we can make use of appendix number 1, table number 1, right? That's the one that you can make use of. So discount factor for 1 year, it says here number of periods. So that's number of years. And then the percentage we are given, right? So first thing, let's go back to the percentage. We are told you that additional information, the after-tax cost of debt is 13%. The after-tax cost of debt is 13%, right? So that's what we are going to use, 13%. So this is where 13% is, in case you don't see. I'm just going to highlight it in red. 13%. So 13% invested for 1 year, it is worth how much? 0.8850. 13% invested for 2 years, 0.7831. 13% invested for 3 years, 0.6931. 13% invested for 4 years, 0.6133. Right, so those are our discount factors. Then how do we get the present value? We take the cash flow and we multiply by the discount factor, right? So this means we are taking that figure there, 230544 multiplied by 0.8850, right? And then we get here 204031. I'm just going to remove the commas, right? And the next one, 230544 multiplied by 0.7831. And then we get here 180539. We go to the next one, 230544 multiplied by 0.6931. And then we get here 159,790. 159,790. Okay, that's fine. And then we go to the next one, 310544 multiplied by 0.6133. And then we get 190,457. Right. So those are my present values. So if I add all of these figures together, then I get the total cost, which is 204,031 plus 180,539 plus 159,790 plus 190,457. And then I get my final figure here of 734,817, right? So that's my total cost. Remember, these are negative. These are all in brackets, sorry. These are negative. So that's the cost for me to what? To actually get this machine if I have to use the leasing method. So it means that in total, it is costing me 734,000 for me to what? To lease this machine, right? So the question, what it is asking you to do is to make a decision. So for you to be able to make this decision, it means you need to go and calculate the cost of owning, right? I.e. the cost of using cash. So you go through the same process again, looking at your costs, looking at your total cash flows, discounting them, and then you get your final value. And once you get your final value for owning, you compare now the leasing and the owning to see which one costs less. That's the one that you want. If the owning costs 600,000, you want the owning because it is the one that costs less at the what? At the end of the day. So that's how you are supposed to conduct question number 3. Right? So when we meet on Saturday, we are going to do the whole question paper from question number 1 up until question number 4, including finishing up on question number 3. For today, I just wanted to do an introduction so that you can see how we do these questions together as a team. Right? So for those of you that are interested, you make your deposit. I'll send through my banking details. I'm sure you also have my number already. Most of you have dealt with before. If you have never dealt with me before, I'll just send my number in the chat there. But I'm sure you have seen my number somewhere, 634. You can send me a message and then we can chat. Then are there any questions for me before we dismiss each other for today? Nati?
Hi, James.
Hello.
I'm checking here on the calculations that you've done.
Okay.
That 80,000, that is,
All right. Let me go back there.
yes.
Yes. Mhm.
I see on the fourth year, that 80,000,
Mhm.
is it not what we call what a residual kind of?
No, it is a residual, but however, look at the statement. What does it say? The lessee will exercise the option to purchase the asset. Because when you have a lease, you don't own the asset. It is owned by the person who has given it to you. It means it's not yours. So at the end of the period, you as the lessee, you have the option to say, look, can I buy the machine away from you? And then you buy it for 80,000, which means it's money going out of your pocket to buy it. So it's unfavorable for you. It's negative for you because you are the one buying the asset after 4 years. I hope it's clear.
Yes, yes, I understand.
Wonderful. Any other questions? Any other questions? All right. If there are no questions, like I said, please join through. If you are not available, you can always still make a payment and then you can get the video recording and the sample of the solutions afterwards so that you can prepare. So what we are trying to do is we're trying to make sure that when we get to 1 February, we know we are done. Then for the whole of February, you are writing by yourself. And then by the time we get to 20 February, when you submit your first assignment, we can start on the project. That's the idea. We want to give you more time to do extra research, to present it differently and whatnot, so that you can avoid plagiarism and whatnot. We don't want you to have those problems. So we do last minute, and then you end up submitting without changing it, and then that's a problem. So this gives you more time to change it, to make it unique, so that there are no plagiarism problems. All right. And then videos are available, like I said, especially financial management, research and quantitative methods. We have videos which we can send you that can help you also navigate some of the different areas. All right. If there are no more questions, please have a pleasant night. We shall see each other on Saturday for those that will be joining. Good night.
Thank you, James.
Nice.
Thank you.
Thank you.
Bye-bye.